Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over and look at some data. I'm going to look at the housing market starts. So it's United States housing starts. I'm going to overlay some information on the housing starts, which is the commodity to stock ratio, when it would throw a buy signal for commodities and a sell signal for commodities. I'll put that up there. And I'm going to overlay all this. I'm going to overlay the oil price. I'm going to overlay Cameco, which has a pretty good amount of data. I'm going to put the federal funds rate on here. And we're just going to kind of look at some data together. I do this with the Platinum membership as well on the finding-value.com. We go over a lot of information. We go over a lot of things and questions that people have. And I think it's important to kind of understand the market conditions. Market conditions are what prices assets. That's what prices assets. A ratio, a ratio of an asset versus an asset compared to history is a way to tell if something's overvalued or undervalued. It gives us more information about the market conditions. And what you see is if you look at all these different things, you look at the ratios, you look at the market conditions. The market conditions can be something on the lines of interest rates, inflation, that type of information. Commodity to stock ratio, that'll tell you where you are. It's all interconnected. It's all interconnected, all tied together. So I'm gonna kind of show you guys what's going on a little bit and what I look for, what I look at. And again, guys, this is also supported at the website as well, as I have a lot of information on the website going over a lot of these different things about the thesis, about how they're interconnected. And then I also go over a lot of the ratio updates and stuff like that I post and talk about even over the camera like this. So let's dive in, show you what I've got right now. I've kind of been playing around with this stuff. So at the top here, what I have, and there's the thing over there. Okay, at the top here, what I did is I took the housing starts. I've got these circles. These circles are the beginning of the bull market of commodities, the end of the bull market of commodities, and the red line, the red arrow, is the bull market ongoing. So it starts here, ends there, starts here, ends there, and we've started a new bull market in commodities. Now, what I took, just to kind of show you guys, I'll blow this up real quick. These are the start and end points that I took. It's the commodity to stock ratio. I took this one and this one, and 1980s this one. This one was a very difficult one to ride through because it gave you a sell signal right at the top here. So you went from buy to sell. This would have been almost impossible to ride completely. So you would have gotten out in 73, 74. And then if you were astute enough to look at the inventories to see how the inflation's going, you would have re-entered. That would have been a very hard play. Much easier on, I think, the 99 to 2008 one. I will say the difficult spot here would have been in 2006. Things started to roll over in the housing market. And we can look at that, and I'll show you what that looks like. And it would have been tough to hold on all the way till 2008, where it peaked out. So it's not going to be an easy ride. I think no one's going to get it perfect. But if you can capture the majority of these moves, they can provide really good outsized gains. And we were very cheap in 2020. That was the everything except commodities bubble that came through. So I'm going to just kind of move this over to the side here. Come on back. That's what these circles are. So buy point, sell point of ideal buy and sell points. And then the buy point in 2020, you could have even bought it a little bit before that in 2019. I was buying a little bit in certain assets a little bit before, thinking that we weren't going to get this kind of blow off crash from the medical event. So what I've got below here, so this is the housing starts. That's the ratio. One thing I want you to notice is that we are always in the positive. This is the average. The white line's the average going across. We are in a positive, large expansionary phase of real estate in every single one of these commodity booms. Is it by happenstance? I don't think so. I think what drove it is the market conditions putting inflation from these expansionary phases of real estate, the liquidity coming into the system, and the commodities not being able to respond to that much liquidity in the system. Interest rates go up. This is your federal funds rate. This is oil here, the Fed funds rate, and on the bottom is CCJ. I know I've got a lot of uranium guys that watch, so might as well talk a little bit about uranium. So if you look and you look at the moves of this, the way that these move in terms of the expansionary phase of real estate, that's when it goes above the average. You can see that the Fed funds rate also goes up with it. It's basically just delayed a little bit behind it. So if it started in 1970, which is here, this comes down, it's just delayed behind it because the housing starts as a leading indicator, and the federal funds rate is lagging behind it, and it's lagging the inflation that is created from this. So if you were to look, it is lagged 1970s here. It's lagged by about 2 years. That's about how long it takes for money to get into the system, be recognized, and then people act on it. So there's a 2-year lag from the housing starts and the loading coming into the system and the ramifications of those loans coming into the system. Here is the bull market. And again, we had a 73, 74 top. That would put you like right in here as the housing starts started to fall. It would have been somewhere in this range as it came back down. It came into a crash zone. Whenever we go below the average, it is a disinflationary or deflationary environment, depending how bad the deleveraging or crash would be. And then we went right back into another bull market. And now the demographics, the size of the demographics caused this double hump. You could clearly see a double hump in the demographics. I don't have a chart of it, but you can see the percent change. What happens is when this demographic hits, it's not a slow rate of change. It's not the volume or area under the curve. It's the rate of change of the demographic that matters. The rate of change, the forcefulness of people going from one state to another state of basically going from not many buyers to a whole bunch of buyers all wanting to buy a house. The rate of change is what inflation is really measuring. It's the rate and the volume of loan growth over a period of time. It's a rate of change. And that's what hit. It hit a massive rate of change growth in both of these. This one wasn't as much as the 70s. And over here, interest rates have really kind of knocked us lower. But that was also a kicker in the beginning of this inflationary kickoff here as we went into an expansionary phase of real estate. Now, if you compare oil to where I've got, oil went from a very low number. I don't know what this is. Okay, here it is. $4 all the way to a peak of about $40. And what you could, or $44 even, almost. So $4 to $40, somewhere in that range. And that's the entire bull market. It was a 10-bagger in oil. Then we went into this disinflationary period. We had a sell signal here. And this wasn't really much of anything. It kind of went up. It wasn't nearly as big as the other ones. And oil just kind of went sideways that entire time frame. Think of this as a large basing period. We went through this big basing period here, and then we broke out. But we should have been buying at basically the breakout here in 1998, late 98, early 99. Right at this bottom here is where we should be buying oil. That's based off of the stock to commodity ratio. Commodities said, hey, it's a buy right here. You would have bought the bottom, and you just have to hold on for a while. It didn't do that much from 98, late 98, 99, all the way to the breakout of 2004. Now, you would have been buying at a very low level. It was about $10. It broke out at $37, and then it really took off on the back half of that bull market in commodities. But that was the measuring here. And if you notice here, there's a couple of things I want you to notice. This one we had the hump, up and down, up and down. But oil never really pulled back here. It just kind of went sideways to slightly higher that entire time frame. There was no pullback with this pullback in housing starts. Even though there was a recession that happened in this time frame with a deleveraging in the housing market and with inflation deflation, there was a recession there, and we didn't see oil pull back there. We didn't really see too much of a pullback. I mean, we did have a pullback here a little bit, $35 down to about 20. That is a pullback, but that was kind of the first wave, and then we kind of came up. There was another pullback from 75 down to about $58, $60, and then the move higher. So what I'm trying to say is, like, there wasn't this gigantic crash that happened in oil during these types of movements. They've been pretty steady. They don't have gigantic pullbacks. Now, in a consolidation period where the housing starts really start to go down, we saw that in 2005 onward, and we went below the average in May of 2007. This is where I start to get worried, is when this thing's dive bombing lower like this, you know that a deleveraging is going to come. That's when you have to get worried. And that's when oil price and all these other things blow up. You also saw right at this time frame when this starts to go lower, you can see that the Fed funds rate went sideways here and started to go down before oil peaked. Those are both leading indicators. So the housing starts going down is a leading indicator of something very bad that's going to happen. We also had, during this time frame, a skyrocketing inventory level. Skyrocketing. I'm not talking about percent gains necessarily, even though I am. I'm also talking about the absolute value of where the inventory was. I don't think you can have a massive crash in real estate if you don't have a lot of inventory. It may take time to build that inventory, and prices can be, I'll say, weak, but I don't think you can have the blowout crash until you get the inventory and people just start saying, screw it, I just want to sell the house. Now, things are slowing down in our markets right now. We can see that the housing starts are coming down, and we're right around that average. We want to see if this dive bombs to the downside below this trend line. If this dive bombs down and we start getting month after month below, like, let's say 1 million, then we got to worry. That is a worrying sign. Now, right now, I'm not as worried, and everybody's panicking about the housing market. They're panicking about home prices coming off their highs. I can't tell you if that's seasonal per se. I think there's a little bit more mixed in than just seasonal. I agree. We're seeing housing starts pull back. And this is going to be a very difficult read to see where we are going to go without getting the next 6 months worth of data. So we're going to find out what we should be looking for in the next 5-6 months. If we're going to come back up, if we're going to go sideways, or if we are going to launch to the downside. Launching to the downside of housing starts will get me concerned, because I think that we are going to see a recession, a deleveraging the system possibly, if loans start to go bad. So that's where we kick in and start looking at the delinquency rate. So housing starts coming down, the delinquency rate, all of those things are going to matter if we break to the downside. Now, if we break to the downside, you can obviously see that oil got crushed. We went into a large consolidation period. So here's some other things that I noticed when I look at data. This is U.S. oil. We're still looking at that. We had the big move in the 70s, and then we had this big consolidation period all the way in the 80s and 90s. We broke out of that consolidation period in 2004, and that's when things got really hot and we started to move. Now, looking at the recent setup, we've got a couple things that are aligning here. We've got the alignment of the housing starts going above the average, which is an expansionary phase, and we're playing with that average right now. I don't know if it's just a pullback that we're going to move higher, or if we're going to go lower, or if we're going to remain steady for a while. I think it depends on many things that we all cannot predict at this time. It depends on interest rates. It depends on what the Federal Reserve is going to do. It's going to depend on the size of the interest rates. It's going to depend on inflation, on wages, on employment. There's a bunch of different things that matter that go into this equation that I think makes it highly complex. And the best thing to do is not necessarily worry about all of those inputs to this output here of housing starts. It's just to watch the housing starts and see what happens. That's what I really think is important. But oil's broken to the upside of this pattern here to the upside. That is a huge positive thing that's broken out to the upside here. Now, these things usually move in three waves. This, to me, we've got one wave, third wave, fifth wave, and then I think we're in a consolidation period. We don't know how big that consolidation period will be. Sometimes they consolidate just sideways. Sometimes they consolidate lower. Maybe we even get a full retest back to this breakout level of where it's at here. That is all possible. But I don't think it's necessarily done from a big picture view. Now, when you look at the federal funds rate, we notice these long cycles. We have a cycle from the 1960s here, where we had an increasing interest rate environment, basically back in the 50s. It actually started in the 40s. From the 40s all the way, and it ended in 1980. A very long increasing interest rate cycle that occurred during that time frame. And in that cycle, we had a demographic that came into home buying years and kind of kicked this gigantic thing off, where we had much greater rates of inflation. We went into a demographic in 1980 after the baby boomers coming off of home buying years. We went and we declined in that population growth. The growth rate declined, not the rate, we didn't go negative. Just the growth rate declined. And we opened up, oil supply to the entire world. We were doing a global, we were importing, exporting oil and all that stuff throughout the world. And we went into a long consolidation period of interest rates, the Fed funds rate basically going with higher lows or lower highs and lower lows, that big decline. But if you look here, we've broken to the upside of that long-term decline of the federal funds rate. Now, is this a new era? It could be. It could be a new era where we're entering like the 1940s. But I think that it's more pronounced than just the 40s. The 40s, they also had high levels of debt, but they also had copious amounts of resources that they could expand the GDP into. And this is where it gets very difficult because, and what I mean by difficult, I think it's difficult to project exactly how this is all going to play out in terms of the path of that we're going to take. So what happens is we went into an expansionary phase of real estate, and they had to cut this down because we didn't have the energy or the minerals to accompany that type of expansion in the system, and it was going to be highly inflationary. So I think Powell knows that, and he had to get on it with the federal funds rate and just start yanking it higher, because what they say is they need to get inflation under control. And in order to get it under control, he needs to basically hold down the housing starts. That is how he's doing it. He's taking interest rates, flinging it way up there, and he's holding down the interest rate or the housing prices and trying to hold this all down through the interest rates. Now, here's the problem that he's going to run into. There's multiple problems here that basically puts him into a corner where he gets stuck. Now, in order for the inflation to kick up naturally, not stimulus money, but just naturally, housing starts have to go up, and loans against those housing starts is a credit expansion phase. That is inflationary. And it's going to push oil through the moon, because oil right now, at least as far as I can tell by looking at all of the inventory numbers, by looking at production and supply, production supply, is we are constrained on energy. And if that money comes into the system, it puts everything into a shortage. And all of those things are made using oil, using energy or oil directly, because that's the number one commodity. It's oil. So everything transfers through oil. Oil transfers all that consumer price index inflation onward when oil goes up That's kind of the leading master commodity. That's the transfer mechanism of the inflation that's created here into all of the consumer price index numbers. And that is where they're backed into a corner. They're backed into a corner because if there's a shortage in oil, it's going to come up in the consumer price index number. So they're increasing the interest rate, and they can't hold the interest rate there forever. Because what happens is the interest expense, the payments from the interest rates, puts all of the existing debt into the interest payments balloon. And they're going to have to print money to cover those interest payments. They're going to have to print money to cover all of the Medicare, Medicaid, Social Security stuff that is indexed to inflation. All of those payments go up, which is inflationary. And it all comes back to oil. Because if you get inflation from the housing, the housing starts and the housing supply there, you can get inflation there, but if they get the interest rates to kick on up and you have inflation in the system, and the way that they're holding it all down is through higher interest rates, you're going to get inflation from the money that is printed to cover the interest payments and the Medicare, the Medicaid, the Social Security, and all those payments that come out with the baby boomers coming into retirement age and all of those obligations that they have. So they're backed into a corner where if they hold interest rates up for a very long time to hold the housing starts down, they're kind of screwed from the angle of the interest rate payments and the inflation and all the indexed payments on the Social Security stuff that the baby boomers are all now collecting in greater and greater quantities. They're running larger and larger deficits based off the demographic of the baby boomers. And with the millennials coming into home buying years, they're getting it from both angles. It's going to be a difficult outcome to manage. And then oil, which is also in short supply, is basically screwing them over because there's no relief from the gross domestic product side to really pull ourselves out of it from a gross domestic product standpoint. So you're looking at which could be a highly inflationary environment any way you look at it, because if they hold interest rates high enough to basically slow down the housing market, they get hit on the interest payments and the obligations. Oil is now running them because they can't control, they don't produce oil. And oil is the transfer mechanism for GDP and consumer price index. So if oil is expensive, you have high CPI numbers, and that's going to hurt them because they're going to have to hold interest rates up. The bond market's going to want to sell off. They want a real rate of return. And if we can't grow an ample supply of oil throughout the world, then your GDP is going to be limited. If your GDP is limited and they continue to print money, what that does is you have more money in relationship to goods and services. That is inflationary. And I think that's what the Fed funds rate breaking out of this downward trend line, I think that's kind of what it's telling us to some degree. Now, this could be ultra volatile. The expansion of GDP, the contraction of GDP, how much energy is out there and whatnot, we could see boom and bust cycles happen rapidly. And I think it's going to be very volatile under these types of conditions. And it depends on what people kind of think and wake up to this kind of market condition. So we're in this market condition where they're stuck on an inflationary front where I think it's going to be inflationary no matter what, to some extent. I don't know what the levels will be, but it will be inflationary, I think. Oil is also in this weird scenario where we can't really increase supply all that much. We can hear the Middle East talk about that they're at pumping capacity. We can see that shale oil is rolling over, and we're seeing our inventories get eaten up. This is a highly complex problem to solve. And I think it's going to turn into a predicament where they start handling outcomes. They can't actually solve a problem here. They're going to have to handle outcomes. And one thing else I also wanted to note is the bull market, and we could see oil that was kind of moving up the entire way. Uranium, at least CCJ, was very delayed. It kind of did nothing all the way out till about 2002, 2003. It was a late sprouter, so to speak. And then it just went ballistic after, 02, 03, it really took off. 02, 03 is when the DXY went lower. We also saw a softening in the Federal Reserve. The Fed funds rate went down. And we had this cycle up, cycle down, and then we cycled back up again. So that's where things really started to take off. We could still be early in this mix where, is this the first cycle here where, maybe this line was back here? I don't think so. I think it is aligned here. We could have a cycle up, a cycle back down, and then another big wave. What we saw here is we had that kind of first cycle here. It was coming back down. We got the buy signal in the expansionary phase, and then we had 2 more cycles after it. The 3 waves is what they talk about. I think that's probably going to come in waves. The federal funds reserve, federal funds rate is going to be in higher highs, higher lows, and we'll probably get a couple of different waves. It's going to be difficult to catch and time all of this on the short term because it's going to be incredibly volatile. So I'm riding through all of it. I'm riding through the big expansionary phase here. I'm going to ride through it. And I think it's going to be an inflationary decade plus, maybe even inflationary from this point forward. And maybe these things will do well no matter kind of what those market conditions are in housing, based off of the credit cycle coming towards its end and based off the obligations in the system and the interest payments. And I'm trying to learn more about those things. Another thing, which is interesting, is we can look at something like an Ethereum or Bitcoin, and I'm not using this to say like we should be investing in it, but what one person can do is this is a function of liquidity in the market. And this function of liquidity in the market means that we've got lots of liquidity in this area here. There's lots of liquidity. This is a tightening cycle here. We can use assets to determine what people think about the liquidity in the system. So if I were to pull this up and compare it to something, I'm going to compare it to gold just for the heck of it and see if there's any sort of comparisons there. And what I think happens is, let me put a vertical line here. Vertical line. This here is early. So gold is kind of like it sees the M2 money supply. And in this area here is the M2 money supply kind of increasing, and gold's kind of real time calculating that. And then if I take, I'm doing this, I haven't tried this before. I'm just kind of doing it. If I take this, that's kind of the duration there, and that's kind of your window. So this here was kind of an inflationary thing, and coming forward, this is your window where it gets into the real world. It takes about 2 years. So 2020, the 2018 printing came into the cycle about 2020, and this is kind of your move higher. We also had money printing that occurred in 2020, and this was delayed behind it. So I think that this is a function of liquidity. It's looking at if there's liquidity in the system. And if I take a trend line, we basically broke this to the downside here, saying, hey, look, we might be seeing another liquidity cycle. And we're also seeing this, it's slow down here. We've got a low, a higher low, and we also have a downtrend line break on Bitcoin here, or Ethereum. And Ethereum broke out. We did a retest move, and I think that we're probably going to head higher here. That is a form of liquidity in the system. These two assets are telling us that liquidity could be coming back into the system. That liquidity could push stocks higher. It could push a lot of commodities higher. And again, this is all speculation. And that's something that I'm just seeing in the system here is that we're breaking out of these downtrends. And you can kind of see where this went sideways here, Ethereum really took off. Another thing that I look for is I look for these patterns. The pattern that I look for, if I were to yank it out of here, is this pattern right here. That is a cycle, that pattern right there. Now, if I were to take it, and I'm just going to go to Sky Harbor. I was looking at a chart that Sky Harbor had. Someone was plotting Sky Harbor on Twitter. And if we look at this, and if I try to like, oh man, I hate when it does that. I'm going to kind of shrink this up and overlay this. And I haven't done it on this this chart here. But if you were to look, the chart and that thing that I took from Ethereum, it looks very similar to, and I know it's not perfect, guys. I understand that. Okay. The pullback here, the way that this thing pulls back is what you get, and I'll do it on this so you guys can see it, is you get a double bottom type scenario. And the double bottom is you basically get this like move in there. It goes one bottom, two bottom, and you'll get this kind of roundish type formation. If you draw this line across there, you get that kind of lead-in pattern, and then you get this double bottom. Are we at the bottom of that double bottom, which puts us at this portion right there? This is overextended based off of the FTX stuff going on. So I wouldn't say that that's I don't think this is, I mean, it could dive down, but I don't think that's necessarily going to happen there. But if I overlay this, and you can kind of see what I mean, that's that little cliff. I'm going to have to extend it out a little bit, and that's what it really looks like. And that's the pattern that I see right there. It looks something on the lines of that. And this one's probably there. It's probably spread out a little bit. And I'm trying to overlay two things. They can stretch and compress. But that's what I see. You can see the exact pattern basically forming. It's a little bit more pronounced in some areas. But I think that this is probably pretty close to where we could be. And then it goes back up. This is the FTX scare. And I think that's an opportunity maybe to go long in crypto, as weird as that sounds. And no, I'm not going to go long in crypto. I'm just saying from a human stance. But that's what I see in this chart. And, I'm seeing it all over the place in different areas. Even in crude oil. Now, I didn't do the overlay of this, but this is crude oil. And what I'm seeing, and it is overly pronounced in one of these areas here. I'll show you what I mean. It's just recently. Let me shrink this way up, guys, because this is a shorter term time frame, and it's something on the lines of. Let me zoom back in here. Okay, and I'm gonna kind of screw the first portion here a little bit. So what's gonna come here is this little sideways movement up is this guy, and oil's very much. That's the movement there. So this movement here, that movement there is that movement here. We came on down, we came on down, we came on up, we came on up. This is basically a complete overlay. We came sideways here, and let me get some of these drawings out to clean it up. And if I were to kind of overlay this portion here, to show you guys that these things basically repeat over and over. That's really what I'm seeing. And I think we're going to bottom here. I think we're going to come back up. And I don't know if we're going to do the FTX scare and all that, but I think we're going to come up and try to break out. So basically what I'm saying is that this also, much like uranium and a lot of these other areas, they've got this little cliff here. It does a double bottom. and then we're going to break to the upside. We're also seeing these double bottoms being put in with like XHB. This is the housing market. There is that double bottom again that I'm seeing, and we're already starting to come back up, and then we'll sit there and break. It's the same thing that we have on a larger time frame of REMX. You can see REMX is doing it as well. There's that double bottom formation, and it looks really good. And if you go on a big picture view, there is also the pattern there of the double bottom. And you can obviously take these things and take the entire bottom here and basically compare these. Let me shrink it way up. And they're not going to be perfect, but we can look at it. And I can show you kind of what I'm seeing here. Oh, I'm not grabbing it this way. Let's shrink it way up. So that is what I am seeing is that type of pattern there. And this is that double bottom. I took the bigger double bottom, pasted it, and looked at it from a shorter time frame, and that is what I'm seeing. And that's usually, if you see what happened afterwards, we have a breakout and then a sideways motion. I think we're going to get another breakout to the upside. But that's what I see right there, guys. And, you know, we're seeing this alignment across everything. And in the short term, again, it's volatile as heck. I understand. But we're starting to see bottoming patterns in the short term. We can see that the Federal Reserve funds rate is broken out of its downtrend, moving to the upside. That could be a signal of a new inflationary paradigm that's coming ahead of us. We can also see that housing starts have broken to the upside for an expansionary phase, and they're being held down by those interest rates. Those interest rates and affordability are definitely holding them down. I've described the predicament that the Federal Reserve is in with having interest rates be held very high for a long period of time, given the obligations and the interest payments on the debt because the debt is so high. And then we also have oil prices that are also in short supply, which is transferring all of this money that is in the system into the consumer price index through the energy pricing. So we've got inflationary pressures from the demographic of the millennials coming into home buying years. We've got inflationary pressures from the tight supply of oil and even natural gas worldwide. And that we could be entering, and I don't know for sure. We've got chart patterns that are suggesting, given all these different areas, that we are putting in potentially bottoms, and we could see a loosening of monetary conditions, potentially. We'll see, and that could be driven. That could be driven, and the market could be wrong here. The Federal Reserve has said Powell's been on it saying, hey, look, we're going to raise rates. And he's been pretty straightforward saying that. The market seems to be pricing in a loosening of monetary conditions in the charts. Who's going to win here? I don't know. That's something that we're going to have to find out. I don't know how many days until he starts talking again. I'd have to look again, but that's what we've got. And I think rates, the Fed funds rate will eventually get to 4.5%, 5%. It's probably where my guess is. And we have a little bit more tightening ahead of us, and then we'll see what happens after that. But market conditions are great here for oil and all these other assets to go higher. But if they come out and they're extremely aggressive with the Fed funds rate and tightening, that may slow us down in our movements. It may reverse it or push it sideways for a while. So that's what's difficult, is to know exactly what the market's pricing in versus what the federal fund, what the Federal Reserve is going to do with the Fed funds rate and all that stuff. And that's what makes all this so interesting. So, but that's what I've got for today, guys. It's a lot to chew on there. If you guys like the content, give me a thumbs up, subscribe to the channel, subscribe to the website if you'd like. We can go over all this stuff that I follow. I go over it a lot during the question and answer sessions. Sometimes I take it from different angles. Sometimes we look at different data. I usually kick something off. Maybe we go through all of the different sectors and a lot of the companies in those sectors and what I'm seeing. But that's what I've got for today. And hopefully you guys are doing all right and hanging in there. All right, we'll catch you next time. This is Finding Value.